Bismillahirrahmanirrahim. Assalamu alaikum. I am Sayyid Akif Shah, lecturer finance at Institute of Business Studies, Kohat University of Science and Technology. The title of this course is Business Finance and the course code of this subject is BS 151. This is our lecture number 14 and the broader topic we have started is time value of money. Under the umbrella of this topic, we will be discussing future value of annuity calculation in this lecture. The outline of this lecture comprises of the types of annuity, and then specifically we will be discussing about the future value of annuity due. So dear student, after listening to this lecture, you should be able to understand what is meant by annuity due, and number second, understand how to calculate future value of annuity due. As we have explained and defined it as an annuity represents a series of equal payments or receipts occurring over a specified number of equidistant period. And then we have explained that there are two types of annuity. One is known as ordinary annuity. If the payment or receipt is occurring at the end of each period, then it is known as ordinary annuity. And if the receipts or payments are occurring at the beginning of each period, then it will be known as annuity due. It means that if certain banking organization is offering you to deposit your money in the bank annuity due based bank account, then you will be obliged to pay your obligation at the start of each period. If this is annual payment, then at the start of the year you will be supposed to pay out your obligation. Let's discuss the steps involved to solve the time value of money, which have already been explained to you in my previous lectures, that you are supposed to read out the problem thoroughly and carefully, then create a timeline, put a cash flow and arrows on the timeline, determine if it is a present value or a future value problem. Also to determine if solution involves a single cash flow, annuity stream or a mixed cash flow. And at 6 steps solve the problem, and finally we can check it out with the help of financial calculator that if we have calculated present or future value of annuity due correctly or not. So let's take a numerical example which is asking us to find out the annuity due. Suppose an investment opportunity which is annuity due is asking you to deposit $1,000 for the next 3 years in bank A, and it promises you to pay 7% compound annual interest rate. And at the end it is asking us to calculate the future value of this annuity. So first of all we need to understand and read out thoroughly this numerical question, and it has been clearly mentioned over here that it is an annuity due. It means that this bank is asking you to deposit $1,000 at the beginning of each year. This was the general mechanism or general pattern of making a timeline for ordinary annuity, which is representing that you are supposed to pay out or receive this yearly cash flow at the end of each year. However, the question is related with annuity due. So let's see in the next slide that how does the timeline looks like for for annuity due. This is a timeline for annuity due, and you can see that timeline 0.0 represent that it is the today's date, the date at which you are making a dealing with the bank regarding this annuity investment. And the day you have made a deal with the bank is asking you to deposit $1,000 at the start of first year. Therefore, beginning of the period 1 has been written in at the top of this timeline 0. When 1 year completes, it is actually the start of the second year. So beginning of period 2 will start at the completion of year 1. So once again you will be required to deposit $1,000 into this banking opportunity to invest your money. Similarly, at the completion of second year, the very next day is actually the beginning of third year. So therefore, once again, you will be required to deposit $1,000 into this annuity due opportunity. So we can see a clear difference that whenever the period begins, you are required to deposit $1,000, and since these payments are equal and as well as at the equidistance from each other, which is 1 year each, equal cash flows, and each one period apart from each other. Let's move to our previous slide. In ordinary annuity, we can see that the investor was required to deposit certain amount at the end of or at the completion of first year, similarly at the completion of second year, and then at the completion of third year. However, in annuity due case, the investor is required to deposit its money at the start of the period, right? Basically, this question, which is the numerical case over here, this question comprises of $1,000 for the next 3 years, right? As we can see that 3 years has been mentioned clearly in this numerical case. Therefore, we have made a timeline which covers 3 periods of investment. Now, after making a timeline and clearly mentioning the amount you are going to invest into this annuity due example, the question is asking us to calculate the future value of annuity due. So dear student, once again there are 3 methods with the help of which you can calculate the future value of annuity due. The first method is the formula method, which has been mentioned over here, and we can see that in this octagon a D in addition to the future value of ordinary annuity has been mentioned to bifurcate or differentiate it from the simple formula for future value of ordinary annuity. When we mention D over here, it means that this is referring towards the future value of annuity due. Over the timeline, we can see that this investment opportunity is providing a certain percentage as compound interest, which the investor will earn over the number of years. In our case, actually the timeline comprises of only 3 years. So therefore, we will be calculating our future value of annuity due at the end of third year. However, if there are more years like 4, 5, 6, so on and so forth up to n, then we would be calculating our future value of annuity due as per the question's guideline. Let's say if the number of time period would have been 6, then we need to extend our timeline accordingly. The general formula for calculating future value of annuity due looks like this: is equal to subscript n represents the number of years this investment opportunity will prevail, is equal to R is our periodic cash flow, which is 1000, 1 plus I raised to the power n. It means that our first investment will compound to the number of time period available into question. In our case it is 3, so therefore we are limiting our timeline to 3 years. And let's remove this R from here. So therefore this cash flow will take 1, 2 and 3 jumps by compounding with 7% interest rate. Therefore in our first cash flow, or we are just making the power or giving power of the number of years this annuity will prevail. Similarly, the second cash flow R into 1 plus I raised to the power n minus 1, because the number of time period over here are 3. So that 3 minus 1 means the resultant value will be 2. And what does this 2 means? That the second year's starting cash payment will take double jumps over here and then to reach over here. So therefore it will take compounding twice, and finally this second year cash flow will take only one time to compound and to reach at the end of this period. So therefore the formula looks like this, or another way around you can also use this simple formula, that is to use future value of ordinary annuity formula and then multiply it with 1 plus I, the given compound interest rate, and you will get the same answer. Let's put the values on the timeline. We were supposed to invest $1,000 at the start of the year, and once again $1,000 at the start of second year, and then $1,000 at the beginning of third year. And the question was asking us to calculate the future value of annuity due at the end of third year. So therefore this 1,000 will take only one time to compound over here. This 1,000 will take two jumps to be compounded and reach here. And similarly this start of the time period investment will take three jumps to reach at 0.1, 0.2, and then to reach at 0.3. We can put the values 1,000, 1,000 and 1,000 along with this compound annual interest rate into the formula of future value of annuity due, and we will get the same answer. So after just putting the values, we come up with the result, which is 3,440. After simple mathematical calculation, we have reached to the conclusion that future value of this annuity due will be 3,440. So it means that if you are going to invest your money $1,000 each, one period apart from each other, and it is the annuity due investment opportunity which provides you 7% compound annual interest rate, then at the end of 3 years, which is over here, you will have $3,440 in your bank account. This was the first method. The second method is to use the table method. So once again we can go back to the book Annexure, which is written by Van Horn, Fundamentals of Financial Management book. You can find out in table 3 the relevant factors. The formula for future value of annuity due is R, which is representing the cash flows, cash receipts or cash payments, into future value interest factor for annuity table at subscript I percent, which is 7% compound interest rate, and for the 3 years. Only one more addition needs to be done by the students to multiply it with this factor, which is 1 plus 0.7, which will give you the resultant value like this, 1.07. And you are supposed to multiply the future value of ordinary annuity with 1.07, and you will get the resultant value or the answer for future value of annuity due. The reason of this multiplication is that you are investing or paying out the cash flows at the beginning of the period, and this beginning nature or beginning investment is actually requiring you to compound it one more time than the simple ordinary annuities. So after putting the values over here and checking the relevant factor for future value of ordinary annuity at 7% and 3 number of year, the point at which they intersect is actually 3.215. You can multiply 1000 with this factor 3.215, and then additionally you need to compound it one more time. The reason of one more time compounding is that you are investing your money at the beginning of each period. So therefore it will get an additional compounding also to reach at the maturity date. The answer with the help of this tabular method is 3440. Let's compare this with our previous answer, which we have come up with the help of formula, was 3440, and with the help of tabulated or table method we have once again get the same answer. It means that here the rounding of values doesn't make a big difference, and the resultant answer with the help of both method are same. It means that if you are going to invest into this bank opportunity, which is asking you to deposit $1,000 at the beginning of each period, which is actually the annuity due case, then at the end of third year your bank account will have $3,440. It means that you have earned $440 with your this investment. Finally, we can also solve this question with the help of financial calculator, which I have told you in my previous lecture that you can buy a financial calculator from open market. But in order to calculate the future value of annuity due with the help of financial calculator, you are required to perform certain step or certain setting before you reach to the relevant answer. Otherwise, it will give you the future value of ordinary annuity. So the step number one is to press second button and then press a beginning BGN beginning key. Then step number two is to press the set button and then press the key. And step number three is to press the quit button, and your financial calculator is now ready to calculate the future value of ordinary annuity. This beginning function needs to be incorporated into the financial calculator because the calculator doesn't know that either you are calculating future value of ordinary annuity or the annuity due. Since our case is annuity due over here in this lecture and in our case, therefore we need to incorporate this beginning feature into the financial calculator. And now we are ready to just insert our data available in the question into the financial calculator. The n represents the number of years this annuity will prevail or required number of years to get mature this investment opportunity. I represent interest, compound interest rate. Y represent yield. Yield and compound interest rate are same. Present value is not required. Future value is the requirement of this question. This PMT represents the payment to maturity. That is, at the start of each period you are required to pay out $1,000. So therefore a minus sign has been mentioned over here, and then you can just simply click the enter button and you will get the most precise answer, which is 3,439.94. The financial calculator usually gives you the most precise answer. The reason is that it incorporate all the decimal points into operations, and finally it gives you the more precise answer. However, in the formula method, because we are doing it manually, so therefore we just round the decimal places up to 2 points or 3 points or 4 points, but human error is possible. The required decimal places are subjective to the person performing or solving these questions. So therefore a slight variation between the calculation of financial calculator, tabulated method and the formula method is actually because of the decimal places one is selecting for solving these questions. But we can see that there is only a slight difference between the answers. So we can say that all three methods are very good to come up with the future value of annuity due. With the help of formula, we reached at 3,440. With the help of tabulation table method, we reached to the same answer. And with the help of financial calculator, there is only 0.06 difference, which is very minute and negligible. Thank you very much for listening to this lecture. If you have any question, just feel free to post on KCMS, our system, or via email, and I'll be happy to answer your queries. Good luck for the day. Allah Hafiz.